Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Financial Statement Analysis, a complete guide. Financial Statement Analysis, a simple guide to understanding business performance. Understanding a company's financial health doesn't have to be overwhelming. Financial statement analysis helps break it all down. By reviewing key reports like income statements and balance sheets, you can discover patterns and trends that reveal how a business is really performing. Whether you're making investment decisions or steering your own company, these insights are critical for informed choices. Let's simplify the process and show you why this skill matters. What are financial statements? Financial statements are the cornerstone of understanding any business's financial health. These reports give a snapshot of the company's assets, liabilities, revenues, expenses, and cash flows. Whether you're an investor, entrepreneur, or just curious about how businesses work, financial statements tell the story of where money comes from, where it goes, and what's left over. Let's unpack the 3 primary statements: the balance sheet, income statement, and cash flow statement. Balance sheet overview. The balance sheet is like a financial photograph of a company at a given moment. It's split into 3 main parts. Assets. These are the resources a business owns. Think cash, equipment, real estate, and inventory. Assets are separated into 2 categories. Current assets, like cash or accounts receivable, are expected to be used within a year. Non-current assets, like buildings or machinery, are long-term investments. Liabilities. These represent what the company owes to others. Examples include loans, unpaid bills, or wages. Like assets, liabilities are either current liabilities, due within a year, such as accounts payable. Non-current liabilities, long-term debt, like bonds. Equity. This is what's left after subtracting liabilities from assets. It's the owner's stake in the company, often called shareholders' equity in corporations. In simple terms, the equation is assets equals liabilities plus equity. This equation always balances, showing how resources are funded. Income statement overview. The income statement tells you if a company is making money over a specific period. It details revenues. These are the total earnings from goods or services sold. For example, a retail store's revenue includes all sales to customers. Expenses. The costs of running the business. This includes everything from salaries to utility bills, raw materials, and rent. Net income. What's left after subtracting expenses from revenues. If this number is positive, the company made a profit. If negative, it ran at a loss. Think of the income statement as a report card for profitability. It's often broken down into subtotals such as gross profit, revenues minus direct costs, and operating income, profit before taxes and interest. Cash flow statement overview. A business can look profitable but still fail if it runs out of cash. That's where the cash flow statement comes in. It tracks money flowing in and out of the company through 3 categories. Operating activities. This is the cash generated by daily operations, like paying suppliers or collecting customer payments. Strong cash flow here is essential for survival. Investing activities. These include buying or selling long-term assets, such as equipment or real estate. While these can drain cash in the short term, they often support growth. Financing activities. This section shows how a business raises money or returns it to investors. Examples include issuing stock, borrowing funds, or paying dividends. The cash flow statement provides a reality check. While the income statement shows potential profits, this report shows whether the company has the liquidity to meet financial obligations. Each financial statement offers unique insights, but together they create a clear picture. By understanding them, you'll have a better grasp of how money moves and grows in a business. Importance of financial statement analysis. Financial statement analysis is the key to understanding how a business operates. By examining financial data, stakeholders can uncover how a company generates income, manages expenses, and balances assets and debts. Whether you're planning to invest, lend, or manage a business, analyzing financial reports helps you make smarter decisions. Let's explore how this works for different groups. Investment decisions. How investors use financial analysis. Investors rely on financial statement analysis to decide where to put their money. Why? Because no one wants to invest in a sinking ship. By reviewing a company's financial performance, they gain insight into its profitability and growth potential. Here's what they often look at. Revenue growth. Are sales increasing year over year? Profit margins. Is the company efficiently turning revenue into profit? Return on equity, ROE. How well is the company using investor funds to generate earnings? For example, if a tech company shows steady revenue growth but declining profits, it might signal rising costs that could hurt future returns. On the other hand, a balanced income statement and strong cash flow might indicate a company poised for expansion. Investors also assess industry benchmarks. If a company is outperforming its peers in key metrics, it becomes a more attractive investment. Financial statement analysis, therefore, provides a framework for making informed, data-driven investment choices. Risk assessment. How creditors evaluate financial health. For creditors, lending money isn't just about trust, it's about evidence. Financial statements give creditors the data they need to assess whether a company is a good risk. What specific numbers matter to lenders? Liquidity ratios. Can the company pay its short-term obligations? The current and quick ratios often answer this. Debt-to-equity ratio. Is the company taking on more debt than it can manage compared to its assets? Cash flow from operations. Is there enough cash generated from daily activities to cover loan repayments? Imagine you're a bank considering a loan for a retail business. If their balance sheet shows excessive short-term liabilities and their cash flow statement reflects weak operational cash flow, you'd likely think twice before approving the loan. Creditors use these insights to gauge a borrower's stability and ability to repay, helping them minimize financial risk. This ensures both sides, from lenders to businesses, have clearer expectations from the financial relationship. By understanding these perspectives, it's easier to see why financial statement analysis isn't just another spreadsheet exercise. It's a decision-making tool that impacts everyone involved. Key financial ratios. When analyzing financial statements, key financial ratios act as essential tools to measure a company's performance. These ratios simplify large data sets into actionable insights, helping you assess liquidity, profitability, and overall financial structure. Let's break down the most important ratios and what they reveal. Liquidity ratios. Liquidity ratios show how well a company can cover its short-term obligations using available assets. They highlight financial stability and operational efficiency in the near term. Current ratio. The current ratio compares current assets to current liabilities. It answers a simple question: can the company pay what it owes within a year? Formula. Current ratio equals current assets, current liabilities. Example. A current ratio of 1.5 means the company has $1.50 in assets for every $1 in liabilities. Quick ratio, acid test. The quick ratio refines the current ratio by excluding inventory, focusing only on the most liquid assets. Formula. Quick ratio equals current assets inventory, current liabilities. Why it matters. If inventory takes time to sell, this ratio shows how quickly the company can meet demands without relying on sales. Profitability ratios. Profitability ratios measure how effectively a business generates profit relative to sales, assets, or shareholder equity. These ratios reveal long-term financial success. Return on equity, ROE. ROE shows how efficiently a company is using shareholders' funds to generate profits. Formula. ROE equals net income, shareholders' equity. How to interpret it. A high ROE indicates effective use of equity to create earnings. However, extremely high ROE might mean excessive leverage, which isn't always sustainable. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.